Okay, let's get started with this deep dive. Today, we're jumping straight into a source to get up to speed on investing.
Right.
It's an article from The Motley Fool, June 6th, 2025, by David Jagielski, and it's really digging into opinions on two specific ETFs, exchange-traded funds.
Yeah, and specifically for growth investors, the kind looking for that buy and hold for years
Yeah,
strategy.
exactly. So our mission here is pretty straightforward.
Mm.
Understand what this article sees in these two particular ETFs, why these two.
And it's a good reminder, ETFs are super flexible. You can find one for almost any goal, long-term growth included. There are tons out there, some broad, some really thematic.
But this piece zeroes in on just two the author thinks are, well, promising for the long haul.
Yep. So the goal highlighted in the source is finding ETFs for long-term growth investors, stuff you can potentially buy and not worry about constantly checking.
And the two funds it puts forward are the iShares Exponential Technologies ETF, that's XT, and the Invesco QQQ Trust, which is QQQ.
Right. The article literally calls them promising investments you can buy and forget about for a long while. That phrase kind of sets the tone, long-term view.
Okay, let's unpack the first one in XT. The iShares Exponential Technologies ETF. What's its main angle, according to the article?
Well, the source describes XT as focusing on companies that are global innovation leaders. It specifically targets what the author calls potential disruptors.
Disruptors.
Yeah, companies whose new tech could, replace older ways of doing things. That's the idea.
Ah, okay. So really focusing on that cutting edge. What does the article say about what's in the fund, the actual holdings?
It mentions it holds around 200 stocks, so quite a few.
Yeah.
And it's a mix, includes both big companies and smaller ones.
Any examples given?
Yeah, the article points to some names in its top 10, like Palantir Technologies, Cloudflare, and Zscaler, names you'd associate with that disruptive tech space.
Definitely. And the article flags diversification as a key point for XT.
Yeah.
Right? How does that play out?
Absolutely. The source really emphasizes that. It notes the largest holding is actually less than 1% of the whole portfolio.
Wow, less than 1%.
Yeah. The author specifically says this means you don't have to worry about having too much exposure to any single company. It's really spread out.
Okay, so broad exposure. How does that translate into sectors? Where is the money allocated?
So based on the article's breakdown, tech is, unsurprisingly, the biggest chunk, 54%.
Yeah.
Then you've got healthcare at 15%, industrials at 7%, and financials around 5%. So tech-heavy, but definitely pulls from other innovative areas, too.
Got it. What about the costs, the expense ratio, and maybe any dividend income?
The article states XT's expense ratio is 0.46%. The author thinks that's a fairly modest fee, especially considering how diversified it is.
Okay. And dividends?
Not much there. The yield is around 0.7%. The article basically says don't expect much income. It's really built for growth, not dividends.
Makes sense. And performance. How is it done, according to the source?
The piece says XT returned over 40% in the last 5 years. It's positioned as a solid long-term investment option packed with up-and-coming growth stocks. The suggestion seems to be it's got legs for the future.
All right, so XT, broad, global, diversified innovation focus, modest fee, solid past 5 years, according to the author. Now, how about the other one, QQQ?
Well,
The Invesco QQQ Trust. How does the article contrast that one?
QQQ is quite different. Its job is to track the top 100 non-financial stocks on the Nasdaq exchange.
Top 100 non-financials on Nasdaq.
Okay. And because of that specific focus, the article immediately flags it as not as diversified compared to XT. That's a key difference highlighted.
Right, not as diversified. What does the article say is the implication of that? For returns and risk?
Well, because it's focused on those top 100 and it's market cap weighted, you get much more exposure to the biggest individual stocks. The source explains that the performance of those heavy hitters really drives the fund's overall return, much more than an XT.
And the article gives a striking example of just how concentrated it is.
It really does. The author points out that almost 25%, a quarter of QQQ's assets are tied up in just 3 companies: Microsoft, Nvidia, and Apple.
Wow, okay. That's significant.
Yeah, and the article directly links this concentration to QQQ doing so well recently. It calls it a key reason the ETF has performed so well. It even suggests, if you're still bullish on those big tech names, QQQ might appeal.
That's a stark contrast to XT's sub 1% top holding, as the article lays it out. So what about QQQ's sector breakdown? Still tech heavy, I assume?
Even more so, actually. According to the article, tech stocks make up over 57% of QQQ. Then consumer discretionary is next at 20%. Healthcare is much smaller, less than 6%. It really reflects that Nasdaq non-financial focus.
Okay, and the practicals, cost and yield for QQQ.
The expense ratio is lower than XT's. It's 0.2%. The article calls this relatively light, which, helps investors keep more of their gains.
Lower cost, that's interesting.
Yeah, but the yield is similarly modest, around 0.6%. So again, not really an income generator.
So lower fee, but definitely higher concentration. How does the article describe QQQ's performance, particularly against XT and the wider market?
The source says QQQ has actually delivered even better returns than XT over the last 5 years, and it's soundly outperformed the broad S&P 500. Apparently, there's a graph in the article showing this.
Better returns, okay.
Yeah, it's presented as having that potential for market-beating returns, largely because of those concentrated holdings doing well.
And the article notes its popularity, too.
It does, calls it one of the more popular ETFs. And it makes this point that because it always holds the best and most valuable stocks on the Nasdaq, investors might feel confident they're getting exposure to the best and brightest growth investments, kind of reinforcing that buy and forget idea again.
Okay, so this comparison the article draws is fascinating. You've got XT, broad global innovation, then QQQ, concentrated Nasdaq giants. How does the source sort of sum up these two choices for that long-term buy-and-forget investor?
Well, the key takeaway the author seems to emphasize is that core difference. XT's wide diversification versus QQQ's focused bet on Nasdaq leaders.
But the article suggests both could work. It doesn't pick a winner.
Exactly. It presents them both as promising routes for that long-term growth strategy. What the comparison really does, based on the article, is illustrate a fundamental trade-off, right?
Right.
XT gives you that diversification, which might cushion you from any single stock tanking. QQQ, on the other hand, with its concentration in those huge tech and consumer names, has shown higher potential upside recently, but, it comes with that concentration risk. The article is basically showing two different flavors of growth investing presented by this author.
And for you, listening, what this deep dive into the source shows are these concrete examples of how someone might tackle long-term growth with ETFs. You get two pretty different strategies here, at least according to this specific article.
Yeah, you've got the XT approach spreading bets across global innovators, and then the QQQ approach doubling down on the biggest Nasdaq winners.
It's really a look at one author's analysis, laying out two potential paths based on their view of these funds.
Mm-hmm.
So recapping briefly, we've unpacked this Motley Fool article looking at the iShares Exponential Technologies ETF, XT Think Broad Global Innovation, and the Invesco QQQ Trust, QQQ Think Concentrated Nasdaq leaders. The source presents both as potentially solid buy and hold growth options,
highlighting their different makeups, costs, and performance histories, as described by the author.
Right. And that leaves us with a thought for you, building on what the source laid out. The article gives us these two distinct models, XT's diversification versus QQQ's concentration. Thinking about what the article says regarding their holdings, their diversification, the sectors they focus on, what factors based on your own perspective and maybe your own risk tolerance might make you lean toward one approach over the other, or perhaps even suggest looking for a totally different kind of growth strategy altogether.